The U.S. economic growth slows sharply to 1.4% in fourth quarter. The United States economy lost momentum at the end of the year, expanding at an annualized rate of just 1.4% in the fourth quarter, a sharp slowdown compared with the previous three-month period and below Wall Street expectations. The weaker growth reading signals that the economy is cooling after a stronger stretch earlier in the year, as higher interest rates and tighter financial conditions continue to weigh on activity. Economists point to softer consumer spending, moderating business investment, and a slowdown in housing as key contributors to the weaker performance. While household demand had previously shown resilience despite elevated borrowing costs, rising credit card balances and slower job gains appear to be tempering momentum. Business investment has also faced pressure amid uncertainty about global demand and financing costs. The data places the Federal Reserve in a delicate position. Policymakers have worked aggressively to bring inflation under control through higher interest rates, but slowing growth increases the risk of over-tightening and potentially tipping the economy toward recession. Markets are now closely watching for signals on whether the central bank will begin easing policy later this year or maintain its restrictive stance to ensure inflation remains contained. Despite the slowdown, analysts note that a 1.4% growth rate still reflects expansion rather than contraction. However, the sharp deceleration highlights growing vulnerabilities in the world's largest economy and raises questions about how sustainable growth will be in the months ahead.